You've got mail.
Value Investor Club rejected me. Gosh! Guys, I'm still pissed off that Value Investors Club freaking rejected my thesis on Kohl stock. We can see now that 3 months later, after they rejected me, it's up 58%. And why do you think they rejected my Kohl's thesis? You can probably see that enterprise value, which is the market cap plus all the debt the company has. You can see that the market cap is like 1/4 of the enterprise value. They're loaded with debt. And we can also see that this price to tangible book value, basically the price is what the market's willing to pay, and the tangible book value is what the assets the company has. So Kohl's owns buildings, they own assets, retail. So why is it trading at half of what the tangible assets are worth? It's because of all that debt. But what is the debt that's showing up on this enterprise value? It is the leasing obligations. So in around 2020, 2021, there was some accounting change where you had to report all of your leases on the balance sheet as debt. The tricky thing with Kohl's is that most of these lease renewals, you can just not pay for the next 14 years if the store is unprofitable. So they can close the stores that are unprofitable and take off that 14 years off the balance sheet. Okay, the second reason why I think this stock is a great stock is because of the price to free cash flow. The price to free cash flow shows the cash the business is able to generate, and it doesn't take into account depreciation. So these stores are heavily depreciated, and what depreciation does, it drops net income, like the profits. However, free cash flow it doesn't take into account depreciation. So there is what the business is able to generate after everything is paid off. It's what you can use for share buybacks and dividend payments. And you can see it also pays a good dividend yield of 2.6%. As a business, it's an okay business because, it's just selling clothes. We can see that they have $15.5 billion in revenue. Their cost of goods sold, $9.2 billion. At the end of the day, they get $272 million in net income, and they're trading about $2 billion. So a price of sales of 0.14, that is pretty cheap. And if we look at their competitors, let's say Target, and let's look at Kohl stock. Target is a pretty good comparison. My girlfriend always shops at Target, but we also visit Kohl's time to time, and I do like my Kohl's Cash. That's another thing they got rid of, and now they added back. And the last time I visited at Kohl's, that store was popping. Like, I saw that they had like a little pickup counter for all the clothes, the pickup orders, and they were all filled up. And basically customers just walk in, go to their little pickup counter, they have their number, and they go to the number and they pick up their clothes and walk out. So it doesn't cost like a lot to run the store, I'm assuming. Let's see, Target. Sorry, I get sidetracked, like ADHD, big problem for me. Target, we can see that their revenue growth, that top right number, is only -1%. So like over the past 3 years, they've only grown -1%. And we can also see that their operating margins, 4%, same exact operating margins as Kohl's. Gross margin is higher at Kohl's. Net income higher at Kohl's. Free cash flow number higher at Kohl's. So now the main thing I was going to look at for the comparison was the tangible book value, the price to tangible book value. We can see that the price to tangible book value at Target is 4.2x, and Kohl's is 0.5. So what the heck? What the actual heck? All right, so here is the operating income and cash flow statement. Basically, we see that a bunch of squiggly lines up and down, but the main thing I'm looking at is CapEx. We see CapEx going down. So you think, why is that? Why is CapEx going down? CapEx is going down because they finished all of their Sephora stores. And basically, Kohl's has Sephora stores in the middle, and it helps bring in more traffic, foot traffic, so people will go buy their makeup, and then maybe they'll go buy some clothes around Kohl's. We see that the free cash flow is going up and to the right. in the value investor pitch, I said that the CapEx was going to be going down because of the Sephora stores. They have already built all the Sephora stores, and we can see that the CapEx is trending downwards. And when CapEx goes down, free cash flow goes up. So we can see free cash flow going up from 2024 to 2025. And we can expect that to continue if things just keep going as planned, because they're not putting in more Sephora stores. There is some value trap risk as well. So this looks like a classic value trap: high debt, declining revenue, stores are closing. However, they're unprofitable stores. And also they have the businesses, like they have the retail, they own the land, they own the buildings. So that their buildings are trading at a tangible book value half of what the market cap is right now. So we saw that the targets are owned, like the target tangible book is something like a crazy number. So I don't see why Kohl stock can't be a crazy number too, like for their tangible book value. But if we're conservative, we give it a 1 times tangible book value. And all the stores that are remaining after the unprofitable ones close, then come on, you might even get a 1.5x tangible book value, which would be a 3x in the stock price. We can see that the margins, it's just a freaking clothing store. So the margins are not that good, but as long as the operating margin is positive, then they're happy. Guidance for the stock, I mean, they seem okay. They seem happy guiding like -1, -2% revenue growth, which kind of sucks. However, the way they're returning capital to shareholders is by reducing that debt. They have some bonds. Basically, their bonds are trading at a discount. So if they buy back their bonds at a discount, then they're returning the capital to shareholders by the enterprise value going down. And that would help the market cap by either the multiple expanding because they're less leveraged and people are not as scared that they're going to default on the loans. Been declining. Revenue's been declining since 2022. So that could be a reason why Value Investor Club rejected this stock pitch. But the free cash flow is the main thing that I'm looking at. They're able to manage this debt easily, I would say, if everything goes to plan. Their proprietary brands, like the shorts I'm wearing, like these are nice shorts. Like they're spandex and I think cotton, but I really like their shorts. Proprietary brands are Kohl's in-house brands, and they're really profitable for them. So there is some seasonality to Kohl stock. So basically like in December, they're going to do really good. So let's do the DCF now. We're going to check out the bull case, basically 1% revenue growth, 4% operating margins. We can see the trailing 12 months is 4%. In the past, it's been around 4%. And the free cash flow average is 4%. We can see right here by this number. The 2030 exit multiple is going to be 16, which is the historical average. And that bull case scenario, we get a freaking 776% return, or every year we make 54% on our investment. The stock price would be $58. And then the bear case is the Value Investor Club was right and they're not able to manage this debt. Let's say everyone goes to their competitors, shops at Target. They're not able to manage this turnaround. The CEOs are not doing a good job or something like that. I think the current CEO is pretty good. He's turning the ship around, so to say. Let's go ahead and look at the scenario summary. So we can see that I was buying around $12 to $15. I first bought around $12 and I kept buying, and my average cost basis is $15. I also sold a little bit from $12 to $16 when I moved my funds from Fidelity to Robinhood. I just decided to take some profits and I rebought the stock at an average cost basis of $15. You can see that the blended IRR, when I merge all my probabilities together, so I put the probability of the bear case 33%, base case $20, and then the bull case $60. So let's do some quick math. The current stock price is $19 and the tangible book value would be $38. It'd be around $36. So the base case, I don't know. I would say the base case is probably 25% chance to happen. bear case, I would say it's just even lower. I would say 20% chance. And so then let's put the bull case at 55%. We see a 94% upside in the current price. But these are just my assumptions, and I could be wrong. I'm not a financial advisor. I'm just a nurse who has to work 3 12-hour shifts every week. And this is just what I do in my free time. I like to research stocks. And if you like to research stocks and you like to try to beat the market and make a better return on investment, then check out my website in the comments down below. You can start for a free trial. And then after that, I think it's like $25 a month. Or you can do an annual plan and get 2 months free, $250 a year. Thanks, guys, because this is just what I like to do for fun. So might as well share it with y'all. We can see my portfolio real quick. We can see Kohl stock in my portfolio right here. These are the stocks I own. I always try to get above a 20% blended IRR. It says it's a 28% blended IRR. So let's double check that's correct. I might have forgot to update my thesis here. We just click update portfolio thesis. It would show 34%. So holy bananas. We can see some good things happening with Kohl stock. So yeah, we can see that I own about $14,000 of Kohl stock. I am biased. I think Kohl stock is a great stock, but yeah, I'm personally invested. It's not a guarantee to go up or anything. You could lose money in any investment, so make sure to consult a financial advisor, not me, before buying this stock. But yeah, we are up. We're in the green, $2,500 on Kohl stock. And TMDX, man, that stock is booming right now. And my video on TMDX got no love, so make sure to check it out right here. All right, guys, here's my actual pitch I gave to Value Investor Club. So I'm just going to read it off from right here. And it's kind of hard to see, so let's go ahead and go to X and just kind of check it out there. As of right now, the market cap is 1321 mil. 2025 free cash flow is 1128 mil. So that is an adjusted free cash flow yield of 85%. Sephora was added in 2020 to about 80 to 90% of Kohl stores to add to their foot traffic, which increased their CapEx. I expect that CapEx continues to trend downwards, and it directly increases their free cash flow. Year over year has been declining since 2022, so this looks like a melting ice cube, right? Well, the great thing about Kohl's is that it owns 400 buildings, and the other 600 buildings are leased. The main value is the land and the buildings. They bought these buildings in 2000, so these buildings have been heavily depreciated. The depreciation is great because it lowers taxable income. However, it makes net income look lower and less impressive, while free cash flow is unaffected by depreciation. As you can see, the free cash flow is 1128 mil. Net income is 271 mil for 2025. Stock-based comp is negligible. The reason the stock is heavily discounted is the high debt burden. In 2022, a new accounting rule forced retailers to report lease obligations for their maximum probable life, an average of 18 years, even though they are contractually obligated to only do 4 years. So this artificially inflates their long-term debt and leverage ratio because once the 4 years is up, they can simply not renew the contract, and that remaining 14 years disappears. This capitalizes $5.2 billion of lease liability onto the balance sheet, resulting in a terrifying 4x net debt to EBITDA leverage. When you adjust the liability to the actual exercise terms, $2.3 billion, their leverage drops from 4 to 2.1x. They have $674 million of cash, interest-bearing debt $1,436 million, actual leases $2.3 billion. And SEC reported debt is $5.1 billion. Gross margin return, so you see that difference right there. Gross margin return on investment, for every $1 invested in inventory during the fourth quarter, Kohl's generated 50 cents in gross profit. If you analyze this figure, it comes out to roughly $2, which aligns almost perfectly with the $1.95 full year. This shows they are still profitable. 2025 inventory turnover, COGS over average inventory, 9.2 divided by 2.8 equals 3.24. The 5-year average is 3.5x, better than Macy's, 3x, Dillard's, 3.3x, worse than Target, 6x. So you want to get rid of inventory quickly whenever you have retail. DSI, average inventory over COGS, cost of goods sold, 112.5 days. So higher DSI should be monitored. More days equals more sales equals compressing margins. So you don't want your clothing on the shelves for a long time, because then you have to do more promotions, more sales, and that's a smaller margin for you. Tangible book assets are at 4 billion. So 1.3, this is the market cap. 1.3 billion over 4 billion equals 0.3 tangible book value, price to tangible book. Also, their short interest is 25%. I think this can rebound back to 1x price to tangible book, which is roughly $35. 600 million in tariff refunds expected to be a one-time windfall of cash coming in Q2 to Q4. So that came back. It's only going to be about 150 million tariff refunds, but all that is left out of the guidance. So it's just going to be pure free cash flow when that tariff refund hits. Let's see guidance. I think guidance was poor due to projected EPS compression from $1 to $1.6, a consequence of the new 10% debt interest hitting the bottom line. However, that tariff refund was not included. Flat to minus 2% top line sales. Adjusted operating margin 2.8 to 3.4%. CapEx around 350 million. Maintain their dividend. Their catalyst is they can simply pay down debt, reducing leverage, which will expand the multiple, or buy back shares while the share price is depressed. In Q4, they say they likely will just continue buying back their bonds at discounts. Low insider ownership, that's one thing that I don't like about the company. But let's say if insiders do buy, this thing could rocket up. That's all, guys. But yeah, make sure to check out my stock terminal, scan this QR code, and maybe check out this video, which I reviewed AppLovin stock. Thanks, guys. See you.